So these are the disadvantages here. So next what we look at is about the headings of cash flows. Okay, so the first one is operating activities. Okay, there are like three activities. One is operating, one is financing, another one is investing. So first we look at the operating activities. See, operating cash flows which must generate cash inflows to pay all cash outflows. So this is the most predominantly cash generating part of a company. Most of the components of cash flows from operating activities will be those items which determine the net profit or loss of the enterprise. That is, they relate to the main revenue producing activities of the enterprise. See, by nature, operating activities part of the cash flow statement should be the biggest. Okay, it should be consistently the positive cash generating part. Okay, if it's going to be like consistently cash losing activity, okay, then the company would be like in term going towards bankruptcy. The standard gives the following as examples of cash flows from operating activities. So these are the things that are included in operating activities. Okay, cash receipts from the sale of goods and rendering of service, cash receipts from royalties, fees, commissions and other revenue, cash payment to suppliers for goods and services, cash payments to and on behalf of employees, something like salary. So the cash flows classified under this heading shows the extent of new investment in assets which will generate future profit and cash flows. So investing activity is all about putting your money into different assets, okay, whether it could be a non-current asset or a share or a debenture or a loan to another company. So that is about investing. So mostly majoritarily the investing part would be a cash outflow activity only. Okay, so in certain years you might not be investing anything, so in those years it would be like zero, and in certain years whenever you are like investing, the cash outflow would be a huge component here. The standard gives the following examples of cash flows arising from investing activities: cash payments to acquire property, plant, equipment, intangibles and other non-current assets, including those relating to capitalized development costs and self-constructed property, plant, equipment. So you could see here, it is a cash payment of the purchase or the construction of a non-current asset. The cash receipt from sale of property, plant, equipment, intangible and other non-current asset. So in few years you could also like sell these non-current assets. Okay, in those years you would be like getting a cash inflow. Okay, so but if you see it, any company which is like growing, they would like invest again and again in more non-current assets. So the cash outflow would be a huge part for a growing company. If a company is in a mature stage, okay, they would not be like constructing any or constructing or buying any non-current assets, as well as they won't be like selling any non-current assets. So they will have like mostly like the investing activity will not be a major part. Okay, but if you see a company which is in bankruptcy stage or in a turnaround stage, they will sell a lot of non-core assets or unwanted assets. So in that terms, okay, or in that instances, you can have investing activity as a cash inflow part. So cash payments to acquire share or debentures of other companies, so that is also part of investing. Cash receipts from sale of shares or debentures of other enterprises. Cash advances and loans made to other parties. Cash receipts from the payment of advances and loans made to other parties. So it's not only related to non-current asset purchase or sale, it can also relate to share and debenture purchase and sale, and any loans given to other companies, and the loans which are any loans which is issued have been like repaid back. Okay, that also can form a part of investing activities. So the next heading is going to be financing activities. So a company which does not have much of operating cash flows, okay, but they have to invest in machineries and in non-current assets, okay, they have to raise finance. So raising finance is the financing activity. So mostly it would be a positive or a cash inflow activity. But whenever the company pays back, okay, the finances, then it could be a cash outflow activity also. Okay. So it doesn't mean that cash inflow is a bad thing or cash outflow is a good thing or anything like that. Okay. It depends upon the context. So this section of the statement of cash flow shows the share of cash which the enterprise's capital providers have claimed during the year, okay, during the period. So claimed means how much of money has come to the company. This is an indication of likely future interest and dividend payment. So the more the finance is raised, the more interest and dividend has to be paid. The standard gives the following examples of cash flows which might arise under these headings. Cash proceeds from issuing shares, cash payment to owners to acquire or redeem the enterprise's shares. So the issue of shares is an inflow. The repurchase of shares is a cash outflow activity. Cash proceeds from issuing debentures, loans, notes, bonds, mortgages, and other short and long-term borrowings. Okay, it doesn't matter whether it's a short-term borrowing or a long-term borrowing. Okay, it's all about whether it's going to be a borrowing. Okay, so any cash received from issuing debentures or loan notes can also form part of a financing activity. Cash repayment of amounts borrowed. Okay, any repayment of these would be a cash outflow. Okay, so this is about the financing activities here. So methods for preparing statement of cash flows. So there are actually two methods in which you can prepare the statement of cash flow. So the first one is called as direct method. Okay, so direct method discloses major classes of gross cash receipts and gross cash payments. The next one is indirect method. Net profit or loss is adjusted from the effects of transaction of non-cash nature, any deferral or accrual of past or future operating cash receipt or payment, and items of income or expenses associated with investing or financing cash flows. Okay, so there are like two ways you can do it. One is direct method. So directly you get what is the total cash received, cash paid, like that, and you compute the statement of cash flow. Okay, see the statement of cash flow, these methods are available only for the operating activity, not for the financing or investing activity. These two methods are only for the operating activity here. Okay, the indirect activity, what he tells is, let's take the non net profit, okay, and let's adjust the non-cash income and expenses. So thereby what we will get is the cash flow. Okay, and we also adjust the accruals. Okay, any payment that has to be made in respect of last year or the next year is usually ignored. Let's ignore those things and let's take into account any cash which has been paid or received. That alone we will take. So that's about the two methods. We will work both these methods and we'll see how it differs. The direct method discloses information not available elsewhere in the financial statements, which could be of use in estimating future cash flows. See, companies usually do not show the direct method. The reason is it's very confidential. Okay, so it's like very confidential. So companies do not use the direct method. What they usually use is the indirect method, because here we either way we have to give, anyway we have to give SOPL. So SOPL has net profit. So net profit is used and adjusted to prepare the statement of cash flow. Okay, so that's one reason why companies prefer indirect method. However, the indirect method is simpler, more widely used, and more likely to be examined. So in exams, usually you will have the indirect method only, because companies also prefer it, and it's quite like easier to prepare it. Okay, so using the indirect method, this method is undoubtedly easier from the point of view of the preparer of the statement of cash flows. The net profit or loss for the period is adjusted for the following. Okay, so in the indirect method we adjust these elements. We adjust the current asset and current liabilities, because cash gets logged or cash gets released in this current asset and current liability. We will see these things in the problem. Non-cash items such as depreciation, provision, amortization, discount on issue of shares, or preliminary expenses written off. All these things have to be adjusted because they are not cash expenses. Okay, or even profit or loss on sale of asset is not a actual profit. Okay, actual cash inflow or outflow. Other items, the cash flows from which should be classified under the investing or financing heading. So items like dividend paid, okay, or interest paid are usually taken out. Okay, so they might be shown in other headings. So any item which has to be shown in other headings is usually is removed from the net profit. Okay, so when we do this sum, you will get a better idea and clarity. So these are the important points that we have to remember in mind when we do the sum. Okay, so note the following points. Number one, we add back in the indirect method, we add back the depreciation because depreciation is a non-cash expense. Okay, so it is deducted in the net profit. Okay, net profit is a number which is coming after deducting the depreciation. So add it back. It makes sense, therefore, to eliminate it by adding it back. By the same logic, okay, you also have to add loss on disposal of a non-current asset. Any increase in inventory or current asset means your money is locked up. For example, last year you never had any inventory. This year you have 10,000 rupees of inventory. It means your money of 10,000 you have invested in the inventory. So your money is like stuck. So it means an increase in inventories means less cash in hand. Your money is locked in that asset. An increase in receivables also means the same thing. Okay, you have like sold to people on credit, so your money is stuck in the goods which have been sold. And if you have any payables, okay, if we pay off payables causing the figure to decrease, again we have less cash. Okay, for example, last year you have 10,000 rupees of payables, this year you have zero of payables. It means you have paid in this particular year 10,000 rupees to your payables or to your suppliers you have paid. Okay, so an increase in current asset means your cash is locked. Okay, and an decrease in current liability means again your cash is locked. So that's about the important points. When we do this sum, we will get a better idea here.